I think it's a combination of things. First off, that investors are probably taking a little bit of profit after the recovery following the CPI data. Now investors are focusing on what the Fed might do. And I think investors are basically saying that the Fed is probably going to do nothing. They're not going to indicate that they are going to be tapering any of their bond buying anytime soon, and that they're going to reiterate how they want to focus on the employment picture before deciding to start thinking about raising interest rates. So that's why I think we're seeing some action in the growth area, why we're seeing some action in technology stocks, but the market as a whole is heading lower because I think investors are worried that the Fed is behind the curve. I think basically tech is trading based on the movement of the 10-year yield. And with the 10-year yield being a little bit lower, I think the tech is getting its cue from interest rates. Ditto for the growth stocks as well. So I think what's happening also is that there's a rotation that's taking place. Investors who had piled into the value areas are now moving back into the growth area. So very similar to what we saw in the third quarter of last year when growth was doing so well and then investors rotated into value. The market still went up. It's just that investors shifted sides of the boat, if you will. Same with small caps, where small caps ended up getting well ahead of their 40-week moving average. And as a result, investors said, time to shift back into the larger caps, whereas now we're seeing a little bit of emphasis on small caps once again. Well, I think that if the market hears something that it was not anticipating, then we could be in for a surprise. Primarily if the market thinks that the Fed will be tapering their bond buying program sooner than anticipated. I think, as you had said before, because the yield on the 10-year note was coming down, that investors are actually buying up the treasuries rather than selling the treasury. So I would tend to think that the Fed is going to continue with its zero interest rate policy, will continue to buy bonds, and basically just take a wait and see attitude. Well, the Fed won't tell you anything, but the only signal that you could really get would be from the dot plots. So if we start to see where the members believe interest rates will be and when the rate increases are likely to begin, I would tend to say that that's really what the market is going to focus on, basically just looking at the dot plots and trying to figure out when will the Fed start to raise rates. Right now it's in 2023, but if there's a possibility that it's been accelerated to 2022, I think that could raise some eyebrows. Yeah, I think so, because I know several companies that are deciding not to renew their leases and to have their employees be 100% virtual, have them be remote workers. Other companies are reducing the footprint of their real estate, et cetera, because they find that their employees can be as productive, if not more so, by working at home. I think that digital currency, cryptocurrency, is gaining more credibility over time. Certainly when you have Tesla say that it will again accept Bitcoin, when you do hear rumors that the Fed is thinking about creating its own, or the Treasury is thinking about creating its own digital currency, and now with the prospects that digital currency can be a good inflation hedge, I think those three factors together, Tesla, the Treasury, and inflation, could end up giving more credence as to why investors would want to buy into the cryptocurrency.